Well, as we just saw, shares of TD Bank are soaring on news that the incoming chief executive officer is being fast-tracked and that the bonus pay of some 40 executives will be slashed. For a closer look at TD and his outlook on the markets more broadly, let's bring in Denis Taillefer, portfolio manager at Caldwell Investment Management. Denis, thanks a lot for joining us. What is your reaction, first of all, to this news at TD Bank and the rally? The market is certainly applauding this in a big way.
Yeah, they are. I think, it had to be done. If anything, I'm a little surprised it wasn't done earlier. Given the significance of the AML blunders they had last year, the corporate governance issues they had as well with the First Horizon acquisition, or the failure of it. They really, the board and the CEO really dropped the ball last year. And so everyone knew this was coming. And like I said, I'm just a little surprised it took this long, but the market is obviously very happy. It's a fresh start. It really basically allows Mr. Chun to really kind of take over full reign a lot sooner and to be able to really start, doing the necessary changes that need to be done within the bank so they can start moving forward.
We get a lot of calls on TD Bank from viewers who have wondered, after the stock crumbled in the light of the steep penalties handed to it by U.S. regulators, whether it was a buy. Now, any investors who bought it on that huge dip are feeling pretty good by today's 4.5% rally. Do you like the setup for TD Bank from here?
Well, it's funny. We like the setup for banks overall quite a bit from here, but we tend to really focus on catalyst-rich names or stories. The problem we have with TD, the valuation is very attractive, but valuation is not really a catalyst we tend to hang our hats on. So we look to see, what the growth prospects are all for all these banks and how they deploy their capital and so forth. And TD is kind of handcuffed right now on some of those options, right? So being able to grow in the U.S. is not really an option right now. There's not much in Canada that it can go after. And basically, a lot of their increase in expenses are really focused around that whole AML in their U.S. business. So we much prefer the other banks that are basically looking to invest more in artificial intelligence, so really to help drive productivity down the road, and that still have the ability to deploy capital. And we are seeing there's a lot of excess capital in these banks, and that softening of regulation that we expect to see happen over the next 12 to 18 months should really drive more of that capital to be reinvested, right? So we think there's a lot of other banks that are trading at a premium to TD, but that have much greater growth opportunities, and that's kind of where we've been focused on.
I know you're following another corporate story in a completely different sector. Lundin Mining is a base metals mining company. It's based in Vancouver. It does business in several different countries and has trimmed its portfolio after the past year. And that's one reason that Lundin's copper production guidance did not meet expectations, and the stock has come under pressure as well. What's your take on the Lundin Mining story?
It was a bit of an underwhelming quarter. We don't own this name, but I think it was a bit of an underwhelming quarter. The street seems to be somewhat indifferent with it, but like you said, they've basically trimmed out, or they disposed of some of their assets, and they're focusing a little more on some of their core assets. Their two main mines in Chile, I think the outlook over the next 3 years was a little softer than expected. So I think that's where the disappointment would be, but the cost profile has come down as well as their CapEx. So I just think it was a slightly disappointing quarter, nothing to get too excited about. Overall, I mean, the people that have a fairly positive view on copper, if they're in this name, I mean, it's not a bad name at all. Fairly well run with good assets, so I think it's still a good name to hold. If it's a name you were looking to get into, I think you have an opportunity here on any kind of pullback to get into this name.
Okay, another name you like is CAE. That's the Canadian developer of flight simulators and flight simulation services. Why do you like this stock?
Yeah, CAE is a name that struggled over the last several years. We like it because, again, there's quite a few catalysts that are kind of building in the name. So while the long-term story has always been very good, there's a shortage of pilots, and they do, they're a dominant player in the pilot training. We like the fact that, the plane deliveries over the last few years have been under a lot of pressure. One, from the global supply chain challenges, but as well, we all know quite well the Boeing story. They haven't been able to deliver new planes. That's really limited the amount of capacity that the airlines have been able to add to their to their businesses, and that's basically limited the amount of pilot training. So we think as those deliveries really come back, that will be a really big driver of pilot training. And on the defense side of their business, again, they're a really strong player there, but that business has been under quite a bit of pressure. Their margins have been under pressure. Again, global supply chain challenges has really had a negative impact on their margins. A lot of their legacy contracts, with all the inflation that we've seen through over the years, are coming out at break even or slight losses. So as they're kind of working through those legacy contracts and they're starting to roll into newer contracts, we expect to see a much better margin profile on a go-forward basis. So we've got some nice catalysts kind of building their two main parts of the business, and we think those will keep just kind of growing better with time, and this stock should perform fairly well over the next 12 to 24 months.
Okay, why don't we finish with another Canadian stock you like, and that's Stantec, the engineering services company.
Yeah, Stantec is a name we like. We've expressed a few times here on BNN how we like certain themes, and that whole reshoring theme and the semiconductor build out in the U.S., the grid build out. So these are all basically themes that kind of play into Stantec's wheelhouse. So we see some really good organic growth on a go-forward basis. They also have a really strong water division, and we've always really liked that division. Probably one of the fastest growing divisions in engineering. And we think as well, the semiconductor industry uses quite a bit of water, uranium processing, all these different industries that are really picking up quite a bit, use a lot of water, and that really plays into Stantec's strength. So another company that we see some really good organic growth on a go-forward basis, and they're very well positioned for that.